Hello everyone, we are at basis period. In the previous video we looked at the first basis period. As I said, in this video we will look at the second basis period. Now the second basis period is a little complex one, and it is the only complex basis period, to be fair with you. The second basis period will depend on how long is our first accounting period. Now when I say accounting period means this this period, first accounting period. All right, so second basis period, we're talking about this basis period, second basis period here. All right, likewise here, this is our second basis period. Now this second basis period will depend on how long, how lengthy is our first accounting date. All right, in every case we'll have to see our first accounting date. So it depend on our second basis period will depend on how long is our first accounting period. Now in our first accounting period will be either 12 months, more than 12 months, or less than 12 months. So there are three possibilities. So we'll have to look at in all of these examples that whether our first accounting period is more than 12 months, less than less than 12 months, or exactly 12 months. So accordingly we will have to adjust our second basis period. All right, now please come to our notes and we'll read the notes as well now. On the notes it says second basis period. So first of all it says that if first accounting period, when I say first accounting period, I mean this one here. If you look at the board, this one, so this is our first accounting period. If the first accounting period is more than 12 months, then the basis period is last 12 months of first accounting period. Now which basis period are we doing? We've already done the first basis period, so we are doing the second basis period. Yeah, so we are doing the second basis period. So what is the rule for the second basis period? Now second basis period will depend on how long is our first accounting period. All right, now assuming our first accounting period is more than 12 months, then what we'll have to do is, our second basis period will be last 12 months of our first accounting period. All right, I will do some examples, then you will understand it better. All right, now then it says part B, it says the first accounting period, if the first accounting period is less than 12 months, then the basis period is the first 12 months of trade. All right, if the accounting period is less than 12 months, then the basis period is the first 12 months of the trade. Now if we look at example 1 now, please, keeping in mind this rule, which is rule number B for the second basis period. So let's look at the example number 1 now. And now we have already done the first basis period anyway, so we are doing the second basis period. While doing the second basis period, we will have to see how long is our first accounting date. So how long is our first accounting date? Our first accounting date is of 9 months, isn't it? Now we can always look at here, or another way to look at the first accounting date is just simply look at this figure here. So it is 9 months, it says here. So we know that it is 9 months. So our first accounting date is less than 12 months. When our first accounting date is less than 12 months, then rules says that second basis period will be first 12 months of the trade. So second basis period will be first 12 months of the trade. When it says first 12 months of the trade, so it means that we'll simply take first 12 months of the trade. So from 1st of the 1st 2005 to the 31st of the December 2005. So these are the first 12 months, aren't they? So from 1st of the January 2005 to the 31st of December 2005. So the first 12 months of trade are our second basis period. In the case if our first accounting date is less than 12 months. Now look at your notes please and read that second basis period rule part B again. If you read it again, keeping it in mind the case which we have just done. All right, so it was a slip of tongue. Right, okay, then part B, as it says in the notes, it says if the first accounting period is less than 12 months, like in our first example, so our first accounting period is less than 12 months, isn't it? It is 9 months long. So if the first accounting period is less than 12 months, then the basis period is first 12 months of the trade. We've already calculated it anyway. Now I hope that while you have already done the basis period, you can easily do the profit as well for this one. While doing the profit, we will take the £18,000, which is for 9 months. So £18,000 plus we'll take this £12,000. So this £12,000 multiplied by how many months is it? We only need for 3 months, so into 3 over 12. All right. So whatever the total is going to be, I think it is going to be £3,000. So 18 plus 3 is going to be £12,000. All right. So that is the way to do it. So first, our second basis period, if our first accounting date is less than 12 months, then first 12 months of trade will be our second basis period. And accordingly, we will have to calculate the profit as well. Now, while calculating the profit, we need the profit for the first 12 months of trade. First 9 months worth of profit was £18,000, so I've taken that. Now I only need next 3 months worth of profit. So next 3 months worth of profit I will have to take from the second accounting period. And second accounting period was of 12 months, so I only need a profit of 3 months. So that's why I've taken 3 months worth of profit, and I've added this into the previous figure, which was £18,000. Now in this case, our second basis period was like that because our first accounting date was less than 12 months. All right. Excuse me. Now let's look at example number 2, please. Our second basis period. We're doing the second basis period. So our second basis period will depend on how long is our first accounting date. Let's look at our accounting date. We can look there, or we can simply look at this date, this figure. So our first accounting date is worth 14 months long. So it is more than 12 months. So what does the rule say? Please look at the notes again. Second basis period, rule number A, please. If first accounting period is more than 12 months, then the basis period is last 12 months of first accounting period. So we'll simply take last 12 months of first accounting period. So our first accounting period is this one. So last 12 months will be ending on 31st of 12, 2016. So we'll take from 1st of the 1st, 2016. So this will be our our second basis period. So if our first accounting date is more than 12 months, in our case it is sorry, it's not 31st December, it is 31st of August. I'm sorry for that. So 31st of August 2016, and it will be from 1st of September 2015, because it is last 12 months of trade. All right. So what happens is that our second basis period will depend on how long is our first accounting period. Correct? Now our first accounting period was of 14 months, so it is more than 12 months. So in this case, our second basis period will be our last 12 months of first accounting period. So last 12 months of first accounting period will be ending on this date. So it will be 12 months, obviously. So it will start on the 1st of September 2015. Now I hope that you can simply take the profit. So we'll take £28,000 into 12 over 15, because it is 12 months worth of profit. So it will be 12 over 14. So whatever the figure is, just you can just calculate it. Let me do it on this one, or actually I should grab my calculator. So it is £28,000 into 12 over 14, so it is £24,000. So we'll do £24,000. So we'll put £24,000 here, and that is £24,000. All right. So this was the case where our first accounting period was for more than 12 months. So that's why our basis period was made like that. All right, now let's look at the notes again, please. Now in the notes it says that if the first accounting period is equal to 12 months, if it is equal to 12 months, then the basis period is same as first accounting period. Now say for example this first accounting period would have been exactly 12 months. If it would have been exactly 12 months, then we would have made exactly same accounting period in the basis period as well. So that's what it says, that if our first accounting period is exactly 12 months, so we'll make our second basis period as exactly same as accounting period, first accounting period. All right. Next rule, which is the rule number D, it says because we have already done A, B, and C for the second basis period. Now the rule number D says that if there are two 5 Aprils in the first accounting period, then the basis period is from 6th of April to 5th of April. So 6th of April from 6th of April to 5th of April in the relevant tax years. All right. Excuse me. So from 6th of April to 5th of April in the relevant tax year. So we'll do the example number 3 now. So in this example as well, business is started. So second basis, we were looking at the second basis period. So our second basis period will depend on how long is our first accounting date. Our first accounting date is 18 months long. So we'll have to see that if there are any two 5 Aprils in this period. So if you look at this date from 1st of the 1st 2013 to 30th of the 6th 2014. Now there is first 5 April coming in 2013 and another 5th of April is coming in 2014. So it means that there are two 5 Aprils in this accounting period. All right, there are two 5 Aprils in this accounting period. Excuse me. So what does the rule say? That when there are two 5 Aprils in the tax year, when there are two 5 Aprils in the first accounting period, then our basis period is going to be from 6th of April to 5th of April. So we'll do 6th of April 2013, our tax year is 2013-14, to 5th of April 2014. All right, so in this case we have our basis period is from 6th of April 2013 to 5th of April 2014. Again, reason was because our first accounting period is more than 12 months and there are two 5 Aprils in our first accounting period. So that's why our basis period is going to be from 6th of April to 5th of April in our relevant tax year. All right, so that was part D of second basis period, which we have seen on the notes. Excuse me. The next part, please look at your notes now. The next part in the notes, it says that if the first accounting date is taxed in the first basis period, so if the first accounting date is taxed in the first basis period, then the second and the subsequent basis period is same as accounting period. So what does it mean is, we'll have to see that if this date comes in any of the basis period, then the following basis period are going to be exactly same like these. All right, so I'll repeat it again. If the first accounting date, so when I say accounting date, I mean this date, not whole this period. This is accounting period. I'm talking about accounting date. So first accounting date is 31st of the August 2016. So if this accounting date, wherever this comes in our basis period, the following basis periods are going to be exactly same like accounting period. All right, so that's what it says. This is the next rule. Alright, so let's look at the next example now. So we have studied, we have just done the example number 3. So example number 3 has already been done. Next example, if we look at the next example, example number 4 is the next one. We are doing the second basis period. So our second basis period will depend on how long is our first basis period. Our first basis period in this case is less than 12 months. So if it is less than 12 months, so what was the rule if it is less than 12 months? So if it is less than 12 months, then basis period is going to be first 12 months of the trade. It is going to be first 12 months of the trade. Now what rule which we have studied just was that if the first accounting date has already been taxed in the basis period, then the following basis periods are going to be exactly same like a accounting period. Now look at this date, 31st of the 3rd 2010. Has this date been taxed, or has this date already came in this basis period or not? Yes, actually, if you look at 31st of March 2010, it has already been in this basis period anyway. Alright, so the following basis periods are going to be exactly same like accounting period. So our next basis period is going to be exactly like accounting period. So 1st of the 4th 2010 to 31st of the March 2011. Our rule number D, which was in our notes, rule number E, it says that if the first accounting date is taxed in the first basis period, then the second and the subsequent basis period is same as the accounting period. So like I said, that whenever you see this accounting date in any of these basis periods, whenever you see it, the following basis periods will be exactly same like accounting periods. Alright, so that's what we did here, because this date, this accounting date, first accounting date was already been in this basis period anyway. Alright, so 31st of March come before the 5th of April, doesn't it? So it is very obvious. So the following basis period will be exactly same like accounting period. So if we look at this one, we can already, we can always write down the answer, which is £6,000 in this case. Excuse me. Alright, we have forgotten to do this one as well. This was for 12 months, so we'll do the £36,000 into 12 over 18. Alright, so it is going to be £24,000, I think. So we'll do £24,000 here as well. Right then, next example, which is example number 5, we are doing the second basis period. Excuse me. The second basis period will depend on how long is our first accounting period. Now if our first accounting period is exactly like 12 months, then it will be, our basis period is going to be exactly same as accounting period. Alright, so look at the first accounting period. First accounting period is exactly 12 months, so our second basis period is going to be exactly like our first accounting period. So 1st of the 1st 2012 from 31st of 12 2012, and it will be £6,000. And that is rule number B. Rule number C of second basis period. Alright, so when first accounting period is exactly 12 months, then our second basis period is going to be exactly same like first accounting period. Let's look at the example number 6 as well now. We are doing the second basis period. It will depend on how long is our first accounting period. Our first accounting period is worth 10 months, so it is less than 12 months. So when it is less than 12 months, what we do is we'll take the second basis period is going to be our first 12 months of the trade. First 12 months of the trade. So first 12 months of the trade are from 1st of the 9th, and just let me change my marker as well. So we are doing the second basis period where our accounting period is less than 12 months. So it will be from 1st of the 9th 2016 to, so it is going to be first 12 months 31st of August 2017. So these are 12 months, aren't they? All right. Now, before we calculate this profit or loss, let's look at the loss. Let's look at the, not the loss, let's look at the notes, please. So we've already calculated the second basis period, and we have studied the notes about the second basis period as well. Now look at the third basis period. It says if the first accounting date is taxed in the second basis period, then the third and subsequent are the same like the accounting period. It is the same thing which I have already told you a couple of times. So what does it say is that when a first accounting date comes in any of these basis period, following basis periods will be exactly the same as accounting period. And the second rule says that if the first accounting date is not taxed in the second basis period, so if this date is not taxed in the second basis period, then the third basis period is going to be last 12 months of the trade. All right, so it will be last 12 months of the trade. Now we are doing the third basis period, so let's start the third basis period. Look at this date, 30th of 9th 2005. Yeah, it has already been taxed, so it means that we will do the the next one is going to be exactly like accounting period. All right, so let's do the next one. So it is going to be, yep, so from 1st of the 10th 2005 to 30th of the 9th 2006, £12,000, this one, and the next one is 1st of the 10th 2006 to 30th of the 9th 2007, and it is going to be £10,000. I will leave this one for now. All right, I'll just leave this one for now. Let's look at example number 2 now, please. Excuse me. In example number 2, we'll have to see first accounting date, if it is already been taxed or not. 31st of August 2016. Yes, it has already come here. So the following tax years, following basis period is going to be exactly same like accounting periods. So let's go ahead and start this one. So 1st of the 9th 2016 to 31st of August 2017, and then 1st of the 9th 2017 to 31st of August 2018, then the 1st of the 9th 2018 to 31st of August 2019. I will leave this one again here. Do the example number 3 as well. This date, 30th of June 2014, has it already been taxed here? Actually here, this date, 30th of June 2014, it has not been taxed in this basis period. So when it has not been taxed, third basis period is going to be last 12 months of the trade. So last 12 months of the trade means from 30th, so it will end on 30th of June 2014, and it will start on 1st of July, 1st of the 7th, 2013. Right? So these are 12 months, so it is 36 months, so again we'll write down £24,000. All right, so it will be this date has not been taxed, so that's why we have done so. All right, now when this date has already been taxed, then the following dates, the following basis period is going to be exactly same like accounting period. So let's go ahead and put this one. So from 1st of the 7th 2014 to 30th of the 6th 2015, and it is going to be £12,000. All right, so it is going to be £12,000. That is example number 3. Now example number 3 has already been finished. Let's look at example number 4. Actually, example number 4 we have already concluded it anyway. Now look at example number 5. First accounting date, has it come this one? Yes. the following basis period is going to be exactly same like accounting period. So I will just copy and paste these figures, £8,000, then from 1st of the 1st 2014 to 31st of the 12th 2014, and it is going to be £10,000. Now this example, which is example number 6 here, we'll have to see that whether this first date is already been taxed here or not, which is the 30th of the June 2017, 30th of the June 2017. So it is already been taxed here as well. I mean, it has already come in the basis period. So the following basis period is going to be exactly same like accounting period. So we'll need to just copy and paste like we did in the previous examples. So from 1st of the 7th 2017 to 30th of the June 2018, it is going to be £22,000. We might have to do some adjustment with this £22,000. I'll just tell you in a minute. Then the next one is going to be from 1st of the 7th 2018 to 30th of the June 2019, and that is going to be our £64,000. Alright, so we've concluded this example, 5th, 4th and 3rd one as well. So that these two examples, which are example 1 and 2, only these examples are left, and the last one we need to do some adjustments as well. And before we do these examples, let's look at the notes again. Now, the reason I left these first example and the second example was that because the business has not only started in these examples, but business is also going to end. So when the business ends, we need to make some adjustments. Now, adjustments are, you might have already noticed that some of the profits has already been taxed, but we have taken it again. All right, somewhere partly or somewhere the full, on some of the times we have taken the full amount again, even though it was already taxed. Now how? Because if we look at this basis period, so if we look at tax year 4-5, now this figure £6,000 is going to be in our income tax pro forma in tax year 4-5, and we will pay tax on this amount. Now, although we will pay tax on this amount, but we are all again paying the tax on the same amount here as well in the next tax year, because we only have to pay tax on £18,000, but we are paying tax on £18,000 here and £6,000 here as well. So what I mean to say is that same amount is being taxed more than once. So when something happens like that, then we need to make some adjustment to the profits, which is called overlap profits. Now that's what we need to read from our notes. Excuse me. So we have done the third basis period from our notes. Then it says subsequent basis periods. We know that's what the subsequent basis periods are. Subsequent basis periods are exactly same like accounting periods. And then finally it says last basis period. Now this last basis period means that when the business is going to end. Now in our example number 1 and 2, business is ceasing its trade, so it is going to end in our example number 1 and 2. So we will use a last basis period in these two examples. So last basis period says that when trade ends, then the last basis period ends on the business cessation date. Alright, so if the trade ends, then the business will end on the business cessation date. And the second thing is, if last two accounting dates fall in the same tax year, then combine the last two accounting periods. So what we do is that if last two accounting dates, when I say accounting date, means this date. Alright, so if the last two accounting dates fall in the same tax year, then we will combine them. Excuse me. So in this case, if we look at this example, example number 1, now we haven't done these two, have we? We have only done till here, but I haven't done these two. Now please look at these two accounting dates. Could you please tell me that whether these two accounting dates are within the same tax year or different? Actually, I think if we look at the first one, which is 30th of the 9th 2008, it is tax year 8-9. And the last one as well, it is 8-9 as well, and we are only left with 8-9 here if you look. Alright, so that's why we need to combine both of these. So first what we need to do is we'll have to do from the 1st of the 10th 2007 to 31st of the March 2008. Alright, so we need to do this one here, and also we'll have to combine the profits as well. So what we need to do is we do £20,000 plus £5,000, but we need to make some adjustments of the profits which is taxed twice. How? Now if you look at here, this £12,000 is coming from this one, 10,000 is coming from here as well. These two are fine. However, if we combine these two, it is £21,000, 18 plus 3, 21,000 plus 6,000, it is coming as £27,000. £27,000, whereas we should have taxed £18,000 only. So £9,000 is extra which is taxed, so we will deduct this £9,000 out of this one in the final tax period. Why we are doing this 9,000 bit is, and this combining bit, because this business is going to cease, so that's why we are doing this bit. Alright, now let's look at our notes again and read the last basis period again. You will understand it better. When trade ends, then the last basis period ends on the business cessation date. If the last two accounting dates fall in the same tax year, then combine the last two accounting period. That's what we did here. And after that it says overlap profits. When profits taxed more than once due to the basis period rules, then it says THAN. Please make sure you write it down as THEN. Then the excess profits taxed are known as overlap profits. Overlap profit relief will also be given in the last basis period. So we have already given that relief, which is £9,000. This £9,000 was extra, which was taxed twice, so that's why we have taken this one out of here. Alright, so we have already given the overlap profit relief. Excuse me. Now if we look at the example number 2 now, we have copied from here, which is from 1st of the 9th 2016, so it is £12,000 here from this one, then it's £10,000, then it's £14,000. Alright, we have done the £14,000 as well. Now only thing left here is last year, which is 2021. Excuse me. So what we need to do is, so we'll write down 1st of the 9th 2019. Now these last two accounting periods are not in the same tax year, are they? This one is 1920, and whereas this one is 2021, so that's why we will not combine them. So it will be 30th of the June 2020, and profits are £11,000. So but from this £11,000 we need to make some adjustment of overlap profit. Reason is because this business is going to end. We will only make the overlap profit adjustment when the business is going to end. We will not do these adjustments in our rest of the examples, because in first example and the second one, business is going to end. That's why we are making the overlap profit adjustment. Overlap profit adjustment means the profit which is taxed twice, we need to deduct that one. So we have copied from here, which is £12,000, £10,000, 14 and 11, whereas this one is £28,000. So we'll total these two. So £24,000 plus £18,000 comes to how much? £42,000. So this £42,000 is taxed, whereas we should have taxed £18,000. So £42,000 less £28,000 comes to £14,000. So we will deduct £14,000 out of this one, and so this comes as £3,000 into negative. So we'll get the relief. It is not a profit, so we'll have to take the relief on that. All right, and for example number 3, we've already done this one anyway. Example 4 and 5 are done as well. Only thing left is example number 6, and we have concluded this one as well, but only adjustment is with regards to losses. Now please look at the notes again. On the last page, on the end of the page, it says overlap losses. Losses are never overlapped due to the basis period rules. So what does it mean to say is, whenever you see the losses will not be overlapped like we do here. Overlap means taxing again. So like we have done here, we have taxed 18,000 here, then 24,000 here. So total we have taxed 42,000 pounds, whereas we should have taxed 28,000 pounds. So we cannot do it here like that because it is a loss. So whatever loss has already been adjusted, we will not do that again. So we will have to deduct that one out of the total. So that's what we need to make this adjustment here. So while doing the first basis period, we have taken out the loss because it was a loss 46,000 pounds. So we've taken 7 months of loss already anyway. Now while doing the second one, if we look at the second basis period, because our first accounting period was 10 months long, so our second basis period is going to be first 12 months of the trade. So first 12 months of the trade means that we'll take 10 months them ones and then the couple of months in the second accounting period. So if we want to make the adjustment for this one, so what we need to do is I will take 22,000 pounds, so that is 22,000 pounds multiplied by 2 over 12. So whatever is, this is our profit. Alright, so actually I will do the thingy on the calculator as well. So that is 22,000 pounds multiplied by 2 over 12. So that is 3,667. So it is going as 3,667. So that is the profit, and we will have to deduct this profit out of the loss which is remaining out of that, because out of 46,000 pound loss, 32,000 has already been adjusted. So whatever the remaining one is, let me check on the calculator, 32,200 has already been adjusted out of 46,000 pounds. Remaining loss is 13,800. So 13,800 of loss will be adjusted, will be deducted out of the 3,667. So the remaining loss will be less than that. So 13,800 less 3,667. Remaining amount is going to be 10,133 pounds. Alright, so that will be the amount which will be taxed in our tax year 17-18. Now reason we did like that is because under the basis period rules, losses cannot be overlapped. Only the profits can be overlapped, and losses cannot be overlapped. So what happened here is, because it was a loss, so we have already adjusted 7 months worth of loss anyway. So whatever the remaining is out of 46,000 pounds, we will only adjust that one. We will not adjust the full amount again, because overlap rules does not allow us to do that. Alright, so I hope that you have understood this huge and very, very complex topic in an easier way. If you still have any questions, you can just drop, you can just comment under the video, then my assistant will try to answer it. Alright, so that's it, and I will see you in the next video, and we will see most of our ACCA taxation exam. Thank you very much and goodbye.